welcome back to the show. It is time for our weekly retirement alerts. Yep, that's right. Each week we've got an alert that we're going to bring to your attention. And for this week's alert, it is all about what your tax situation is going to look like in retirement. Now, what a great question this is, because I would say for a lot of us, we really struggle to understand taxes, right? Just in general, it's a pretty complicated thing. Most people in this country don't have, let's say the most in-depth understanding of how our tax system works. But forgetting about all of that, during our working years, as we make our income and our paychecks, which is relatively the same on a year-by-year basis, we kind of have an idea of at least what to expect come April 15th every year. And then all of a sudden we go to retire, and because this whole thing is different, most people really have no idea what to even expect as far as their tax situation in retirement. And that's the whole point of what we're going to alert you to today. Plus, we're going to try to talk to you and teach you, some strategies on how we can minimize your tax obligation in retirement, right? So certainly very important there. Now, before we get into some of those strategies, it's probably important just to understand a little bit of the basic tax structure that we have in our country. So what you're going to see behind me is just a 2017 table of our tax brackets, if you were a married couple filing jointly. Now, let's give you an example and say that this married couple was bringing in $120,000 a year of taxable income. As you can see, that would put them in a 25% marginal tax bracket. But not so fast. Let's make sure we understand that. This is a progressive tax system we have. So even if you're in this 25% bracket, those first $18,650 still get taxed at 10%. Then it's only those additional dollars that get taxed at 15% in that bracket. And finally, it's only those additional dollars after about $76,000 that are getting taxed at 25%. So most people, if you've heard you're in a 25% bracket, don't assume that you're actually paying 25% on all of your monies, right? You pay 10% on those dollars, then 15, then 25, so that by the time you actually blend that in, remember your tax rate, what we call your effective tax rate, is going to be a little bit lower. Now, even beyond that, though, we have things like all of the deductions that we might have, right, for some of us more than others, and we've got things like our own personal exemptions or maybe even additional ones if we have kids or other dependents. So the bottom line is, even from there, we still get to lower our taxable income down a little bit. Then you want to look at the total amount of tax you actually paid divided by the total amount of dollars you actually brought home, and you'll find that it's well less than 25%, like the example we're using right now. Now, here's where the strategies in retirement come alive, right? Because in retirement, this is really the first time in your entire life you get to choose where you pull your income from, right? During all of our working years, there's not much we can do about it. Each additional dollar we make from our paycheck is just an extra dollar of taxable income getting taxed at higher and higher rates, right? In retirement, we have an income goal, but now we choose where we pull it from. So things like your pensions, as an example, yeah, that's taxable income. Not much we can do about that. But pensions are a beautiful thing, so we're not going to complain either. Beyond that, let's say we started to pull money out of traditional IRAs, right, 401ks, retirement accounts. Well, each dollar that you pull out of those accounts to spend in retirement will add to your taxable income for the year. So the more that you pull out in any one year, right, the higher your income could be, and therefore the higher rates that your 401ks or your IRAs would get taxed at. So you want to keep an eye on this before the year starts and try not to pull out these dollars that are going to unnecessarily push you into higher brackets. But those aren't the only dollars you might have. If you have things like cash in bank accounts and non-IRA accounts, you can respend that cash with no tax obligation. It won't be taxable income. If you have things like Roth IRAs, well, now that money plus all of the earnings can come out to you 100% tax-free as well. Now, as far as your Social Security is concerned, this is a pretty complicated subject. We don't have time just in this one segment to go into every detail there. But just know that your Social Security can either be taxed where 85% of the dollars show up on your federal return, or if you can limit other areas, then actually none of your Social Security hits your return, or in other words, it's 100% tax-free. So let's try to make this come alive again with one more image you'll see behind me. And really, this is two case scenarios of the same family, right? So this is kind of an actual tax return being played out. Now, you'll see case one and case two. On case one, you'll see that there's a $21,180 of this kind of income that you see. That's from a pension. So again, nothing we could do about that. Now, on case two, you'll see that number jump to about $71,000 and some change. That's because in case two, they pulled $50,000 out of an IRA, right? So again, when you pull $50,000 out of an IRA, it adds to the taxable income. What you'll notice is Social Security right above it, though. On case 2, the IRA money caused more of the Social Security dollars to end up on the return. Where on case 1, because we didn't have the IRA dollars, we also had less of Social Security on the return. So there's kind of this doubling effect there. What we do over here not only adds to our taxable income, but it can cause other things to retroactively be taxable when they otherwise shouldn't be. Now, as you just kind of play this return down and you go down both columns, you'll see that they each get to use their deductions and their exemptions. And the bottom line is on case 1, they brought in about $110,000 of total income for the year, about $39,000 Social Security, the $21,000 pension, plus $50,000 they took out of their bank. But that $50,000 didn't show up on the return, so you'll see they only paid about $457 of actual tax on $110,000. On case 2, they're going to pay almost $14,000 of federal and state tax, which is only about 12.5% off of that $110,000, but certainly much worse than the $457. So this is really just one example, right? We're giving you some basic understanding of the tax system and, more importantly, letting you see on a return how much money we might potentially be able to save in taxes in retirement if we just understand our own situation, the tax code, and which accounts we should be pulling money from in retirement. So again, if you're looking for some tax advice, if you want to make sure your returns are getting done correctly, and if you just want to see how your taxes play out in retirement and how to minimize them, that's what we're here to do. Give us a call, come to the website, and we'll be glad to set you up with some tax strategies in retirement.